You got the raise. You asked for it. You earned it. Your manager said yes. You're making $35,000 now instead of $30,000. $5,000 more annually. That's a raise. That's progress. That's what moving forward feels like. And then you get the first paycheck. The deposit is smaller than you expected. Not by $5,000, by significantly less. The gap between the raise you negotiated and the raise that actually hits your account is strange and unexplainable. You do the math. The math doesn't make sense. You got a $5,000 raise, but your paycheck only increased by $2,000. Where did the other $3,000 go? The answer is the invisible tax, not one tax. Multiple taxes and mechanisms that activate automatically when your income crosses certain thresholds. These mechanisms are designed to feel invisible. They work in the background. You don't see them unless you specifically look for them, and almost nobody looks. Today, we're going to make them visible. Because a raise that looks like progress can actually leave you worse off if you don't understand what the raise is triggering. The first invisible tax, marginal tax rate increases. Here's the first mechanism that's already happening. Your income goes from $30,000 to $35,000. You might think this means you pay the same tax rate on the additional $5,000 that you paid on the first $30,000. It doesn't work that way. The U.S. tax system is progressive and marginal. As your income increases, a larger portion of your income gets taxed at higher rates. If you're single and went from $30,000 to $35,000, the additional $5,000 is not taxed at your average rate. It's taxed at your marginal rate, which is higher. For someone in that income range, the marginal federal tax rate is probably around 22%, maybe more if you're in a state with income tax. So on that $5,000 raise, you're paying roughly $1,100 in federal income tax, plus state income tax if applicable. Maybe another $500 in state tax. That's $1,600 gone before you see it. But there's more. The second invisible tax, FICA taxes on the entire raise. Social Security tax is 6.2% of your income. Medicare is 1.45%. Combined, FICA takes 7.65% of your income. On that $5,000 raise, FICA takes $382. Now you're at roughly $2,000 of the raise gone to taxes before you even see it. But there's still more. The third invisible tax, phase out of benefits. Here's where things get weird and very few people understand what's happening. Certain tax benefits and credits are designed to phase out as income increases. This means that as your income rises, you lose access to benefits you previously qualified for. If you receive the Earned Income Tax Credit, the Child Tax Credit, or other income-dependent benefits, these start to reduce or disappear as your income increases. Let's say you qualified for a tax credit worth $500. That credit starts phasing out when your income exceeds a certain threshold. Your raise pushed you above that threshold. Now you lose some or all of that benefit. That $500 you were counting on in your tax refund, gone. From the government's perspective, they're not giving you the benefit anymore because you're making more money. From your perspective, your raise just cost you $500. The fourth invisible tax, student loan repayment changes. If you have federal student loans under income-driven repayment plans, your monthly payment is calculated based on your income. When your income increases, your monthly payment increases. If you were paying $400 monthly and your income increased enough to push you into the next income tier, you might now be paying $600 monthly. That's an additional $200 monthly, or $2,400 annually. That's getting subtracted from the value of your raise. Your raise is paying for higher loan payments, not for you. The fifth invisible tax, lifestyle creep triggers. Here's the non-tax tax that might be the most destructive. You got a raise. You're making more money. You feel like you've arrived at a new level of life, so you upgrade. Your apartment, your car, your restaurant frequency, your subscription services, your gym membership. You move from a $900 apartment to a $1,300 apartment because you can now afford it. You move from a $500 car payment to an $800 car payment because you deserve a nicer car. You go from eating out once a week to 3 times a week because you can afford it now. These upgrades feel like a natural adjustment to your new income level, but they're consuming the raise before it ever becomes wealth. A $5,000 raise becomes a $2,000 net increase after taxes. Then lifestyle upgrades consume that $2,000. You've made no actual financial progress. You're just at a higher expense level with similar financial margin. The sixth invisible tax: tax bracket creep on retirement contributions. If you're smart about the raise, you might increase your retirement contributions. You take that extra $5,000 and put it into a 4-0- that single quotes as great. That reduces your taxable income. But it also means you have less take-home pay to live on. The raise that was supposed to improve your cash flow gets redirected to retirement savings, which is wise but doesn't help your current financial situation. You're not feeling the benefit of the raise because the raise is going directly into retirement accounts rather than into your spending money. This is actually the financially smart thing to do, but it means the psychological feeling of the raise and the actual financial benefit of the raise are completely disconnected. The real numbers, what actually happens. Let's put this together with concrete numbers. You're single, no dependents, and you got a $5,000 raise. Federal income tax on the additional $5,000 at a 22% marginal rate, $1,100. State income tax at around 5%, $250. FICA taxes at 7.65%, $382. Total taxes, $1,732. You have $3,300 left from the $5,000 raise, but you lose a tax credit worth $300 because your income exceeded the threshold. Now you have $3,000. You upgrade your apartment because you can now afford something nicer. The upgrade costs an additional $400 monthly, or $4,800 annually. Your raise covered 2 months of the apartment upgrade. The rest you're paying for out of your existing income. You also increased retirement contributions because you felt like you should be saving more. That consumed another $1,000. From the $5,000 raise, approximately $5,000 got consumed by taxes, benefit phase-outs, lifestyle upgrades, and increased retirement savings. You have zero additional discretionary income from the raise. In fact, your cash flow might be worse because your lifestyle expenses increased but you're paying more. Taxes and your take-home didn't increase proportionally. Why nobody talks about this? The reason this dynamic isn't discussed in raise negotiations is that it makes the raise negotiation process uncomfortable. If you know that a $5,000 raise only produces $2,000 to $3,000 of actual additional cash flow, you'd negotiate differently. You might ask for more. You might ask for stock options or benefits that aren't subject to the same tax treatment. You might negotiate differently. But employers don't want you knowing this. So the raise is presented as $5,000. You feel good about $5,000. The reality is $2,000 to $3,000. This information asymmetry benefits the employer enormously. What actually changes the equation? If you're smart about a raise, here's what you do. First, calculate the real take-home, not the gross. How much will actually hit your account after taxes and benefit phase-outs? That's the real raise. Second, decide in advance where the real raise goes. Don't let lifestyle creep decide for you. Decide intentionally. Maybe 50% goes to savings. Maybe 50% goes to improved lifestyle. But decide before you feel the bump in cash flow. Third, Use the raise to increase your savings rate, not your spending rate. This is the least fun option psychologically, but it's the one that produces wealth. If you got a $3,000 net raise and you put $2,000 of it to investments and only $1,000 toward lifestyle improvement, you're using the raise to build wealth instead of just consuming at a higher level. Fourth, understand your specific tax situation. Know which income thresholds will trigger benefit phase-outs. Know what your marginal tax rate is. Know how much FICA tax you're paying. The person who understands their tax situation can make better decisions than the person who just sees a $5,000 number and hopes for the best. You got a raise. You negotiated for it. You earned it. You deserve to feel good about it. But the $5,000 you negotiated for is not the $5,000 you received. Roughly 30% of it went to income taxes. Some of it triggered benefit phase-outs. Some of it got consumed by lifestyle upgrades. Some of it went to increased savings. By the time the dust settled, you might have an extra $500 to $1,000 monthly in actual discretionary income. That's progress. But it's not the $5,000 you thought you negotiated for. Understanding this doesn't mean you shouldn't take raises. It means you should negotiate knowing the real number. It means you should decide in advance where the real benefit goes. It means you should resist the automatic lifestyle creep that makes the raise disappear. The raises that actually build wealth are the ones where you understand what's happening to them and you make intentional decisions rather than letting the system make the decisions for you. That's the difference between a raise that feels like progress and a raise that actually is progress.